What's up, everybody? It's me here. So, if you really like most people, and you have money left over after paying your expenses each month, one of the best places to put that excess cash is real estate. And it can be a great way to build wealth slowly but surely over time. But the question a lot of people have is whether or not real estate will still be a good investment in 2025. Now, this comes at a really interesting time because for decades, owning real estate has been heralded as one of the best ways to grow your wealth. In fact, the entire concept of real estate investing is built around the idea that real estate values increase over time. And generally speaking, they do. But it doesn't always happen overnight, and there are definitely some exceptions. For example, from 2008 to 2012, the housing market collapsed, causing home prices to plummet almost 35%. But since then, prices have more than doubled. But now with new challenges, like higher interest rates, the inflation, less buying power, changing tax laws, and the list goes on and on, some people wonder if 2025 will be the year where real estate finally gives out. So let's talk about exactly what's going on, why real estate could continue to be a good investment despite all of these changes, how you could use this information to make a profit. And then finally, we'll address some of the major concerns that could cause real estate prices to drop, and if that would even matter to you. Although before we start, if you appreciate all the information and you want to see more, it would mean a lot to me if you hit the like button or subscribed. Doing that helps out tremendously, and it's a thank you for doing that. Here's a picture of a baby monkey. So thank you guys so much. All right, so first let us talk about why real estate could continue to be a good investment in 2025. Now, in terms of real estate prices, there are essentially two main factors that determine how much something sells for. The first is the price relative to the amount of rent it could generate. This is why properties are usually priced based on a cap rate, which essentially means if a property rents for $1,000 per month, investors will typically pay 12 times the annual rent or $140 for $1,000 for that property. From there, if the rent increases by 5% every single year, the investor could earn a 5% return on their money very quickly. On top of that, once you factor in any appreciation, property taxes, and insurance, most people aim for a 7 to 10% return on their investment when purchasing a property. Now, if that happens, congratulations, you just found yourself a good deal. But if it doesn't, well, then chances are you probably overpaid, and it might not be worth it. The second factor is the cost of capital, or in other words, the cost of borrowing money. For example, if you had a $100,000 property and you put 20% down or $20,000, then finance the rest with a 30-year mortgage at 6%. So even though the market has risen substantially since 2020, the concern now is that both of these metrics are beginning to shift in the opposite direction, thereby causing real estate prices to decline. Second, let's talk about how this could play out over the next few years and how you could make money from this. Well, In terms of real estate returns, it's important to understand that there's an element of risk in everything that you do. For example, if you put your money into a savings account, you're guaranteed to lose value because of inflation. If you put your money into bonds, you're taking on the risk that the company defaults. If you put your money into the stock market, you're taking on the risk that the company underperforms or gets disrupted. And if you put your money into real estate, you're taking on the risk that the property decreases in value. That's why it's always said that the best investments are the ones that offer the highest risk-adjusted returns. In other words, the more risk that you take on, the higher the potential return should be. For instance, if you buy a double-wide mobile home in a trailer park with a 5% chance that it doubles in value, a 20% chance that it stays the same, and a 75% chance that it drops 10% in value. On average, you would expect a neutral outcome, meaning neither a gain nor a loss. But in reality, you have a 5% chance of making 100%, a 20% chance of making 0%, and a 75% chance of losing 10%. So mathematically, this would be a bad investment. However, if you were to invest your money in a triple net lease with a 10% chance of increasing 100%, a 20% chance of increasing 20%, and a 70% chance of staying the same, then you have a 10% chance of making 100%, a 20% chance of making 20%, and a 70% chance of making 0%. When you run the numbers, that ends up being a 14% expected return. Because of that, investors are often willing to pay a premium for investments that offer higher expected returns, especially if they believe that the market is going to continue growing. But the issue today is that while real estate prices have increased substantially, the expected future returns have not. This is why now more than ever, it's crucial to do your homework. Think critically and objectively about the markets, and then buy only if you feel like it makes sense. Third, let's address some of the biggest risks that could cause real estate prices to drop. First, consider that there are always opposing forces within the real estate market. For example, if a city attracts new residents, that could drive up demand and therefore increase property values. However, if that same city also allows for more construction, that could increase supply and bring down prices. It's also worth noting that typically, when a location starts to get too expensive, the local government finds a way to raise taxes, further reducing the return on investment, thereby driving up buyers to cheaper areas. All of that is to say that no area goes up forever without interruption, and eventually market conditions change. Second, don't forget that there is also a difference between a real estate crash and a real estate correction. A correction simply means that the market declined by 10 to 20%. And historically, that happens about every 7 to 10 years. On the other hand, a crash is typically defined as a decline of at least 30%, which generally only happens every 10 to 20 years. The reason for this is because recessions only happen when there's a fundamental mispricing in the market. And if prices only correct 10 to 20%, that doesn't usually solve the core issue, whereas a crash does. And finally, third, there are several things that you could do to protect yourself against a decline in real estate. Prices. For example, if you're planning to buy a property, don't overpay. Stick to your budget and only buy if it makes sense financially. You could also look in up-and-coming neighborhoods where there's a potential for growth. Although keep in mind that these types of properties are often more competitive and they might not be available. You could also try to negotiate a lower purchase price and ask for a rent guarantee or a partial refund if the tenant stops paying rent. Another option is to buy a property with a low price relative to its rental income so that you are able to weather a storm without having to worry about losing money. One way to do this is to look for multi-family homes that have a large enough down payment so that you are able to cover the mortgage in the event that you lose a tenant. You could also look for notes where another person took out a loan on a property. You buy the note, and then you collect the payments over time. Or if you have more money, you could buy an entire apartment complex and hire a property manager to handle everything for you. But honestly, I'll tell you what I did. So, overall, real estate could continue to be a great investment in 2025 and beyond, but only if you buy the right thing at the right price. Personally, I like to focus on buying below market value, especially during a downturn when there's a surplus of inventory. And if you subscribe, I'll make sure to include my favorite resources for finding off-market deals in the description. So, with that said, you guys, thank you so much for watching. As always, feel free to add me on social media. Enjoy! Thank you so much, and until next time.